Number one, the rich don't fund ideas, they fund money-making machines. Here's your first reality check. When I walk into a room full of investors, I don't see dreamers. I see calculators with expensive watches. They don't care about your passion. They don't care about your vision. They care about one thing. Can you turn their dollar into $3? And not tomorrow, not next year, right now. I mean, I've seen founders with world-changing ideas get absolutely laughed out of boardrooms while someone selling accounting software to dentists walks away with $20 million. Why? Because the accounting guy had the numbers. He could prove that every dollar in produced $3 out. The world changer, he had PowerPoint slides and hope. Guess which one writes checks? Your job isn't to sell the dream. Your job is to show them a money printing machine that's already running. Look, if you're pre-revenue, I'm not picking on you. I'm not saying give up. I'm saying change your approach. You're not selling growth capital. You're selling potential. And potential requires an absolutely different playbook. Show them that the engine is built. Show them the early tests are working. Show them you're not just another founder with a Google slide addiction, because investors want proof, not promises. Number two, desperation is the kiss of death. Let me paint you a picture. You walk into a negotiation, the other side can smell that you need this deal more than they do. What happens next? You lose. Same thing happens with investors. The moment they sense desperation, it's game over. Here's what desperation looks like. We really need this funding to survive. Or without this round, we'll have to shut down. Or please just give us a chance. Now, conversely, here's what confidence looks like. We're raising because we found something that works and we want to scale it faster. We have multiple interested parties, but we're looking for the right strategic fit. Or maybe this opportunity won't be available much longer. So do you see the difference? Options. When you have options, investors lean in. When you're desperate, they back away. So here's the rule. Never start raising when you're 90 days away from being broke. Start raising 6 to 12 months before you need the money. Build relationships when you're not asking for anything, just like the bank. The bank doesn't want to loan you money when you need it. They want to loan you money when you don't need it. So send updates when you don't need help. Schedule coffee when you're in control. Create leverage before you need it, because the best deals happen when you don't need the deal, as I just mentioned. Okay, number three, strategic capital raise beats big checks every single time. Story time. We had a client with 2 offers on the table, $15 million from a celebrity investor, this big name, even bigger ego, I won't name names, $8 million from a former enterprise software CEO no one's ever heard of. Which one do you think we took? The $8 million guy. Why? Because that nobody opened doors to $150 million in enterprise contracts within 18 months. The celebrity, great for Instagram posts, terrible for business growth, and certainly no one you want to be in business with. So here's the lesson. Money is a commodity. Strategic value is priceless. Before you take any investor's money, ask yourself, do they understand my business? Can they open doors I can't open myself? Do they have connections that turn into customers? Will they help me avoid mistakes that kill companies? Smart money doesn't just write checks. Smart money builds empires. Choose partners like you're building a law firm. Pick the people who make everyone else better. Number 4, due diligence starts with your Google search. Most founders think due diligence begins when investors ask for financial statements. Wrong again. It starts the moment they type your name into Google. If your LinkedIn looks like you created it during a lunch break, if your company website screams startup on a shoestring budget, if you don't have any credible press or thought leadership at all, you've already lost. Here's what investors see when they Google successful founders. Professional headshots that belong on magazine covers, press coverage from credible publications, speaking engagements at industry events, a digital presence that says, I'm ready for $10 million. Here's what they see when they Google amateur founders. Blurry photos from 2015 MySpace, a LinkedIn that's 40% complete, 0 media coverage, a website that looks like it was built by their cousin. Perception is reality in this game. Run a founder audit. Fix your digital presence. Get some press coverage. Look like someone who handles millions of dollars, because if you don't look ready for the money, they won't give you the money. Number 5, your data room is a sales machine, not a document graveyard. I've seen founders spend months perfecting their pitch deck, then throw together their data room like they're cleaning out their garage. 47 random PDFs in a Dropbox folder No organization, no flow, no story. Your data room should sell harder than your pitch deck. Think of it like this. Your pitch deck gets them interested. Your data room gets them committed. So structure it like a guided tour. The who we are, team credentials, advisory board, key hires, the opportunity, market size, problem validation, competitive landscape, our solution, product demos, customer feedback, development roadmap, talk about traction, revenue, growth metrics, key partnerships, talk about the numbers, financial projections, unit economics, burn rate. Don't forget legal, cap table, contracts, IP portfolio. Every document should answer the question, why would I be crazy enough not to invest in this project? Make it easy for them to say yes. Make it hard for them to say no, because a confused investor is a broke founder. Now, before we continue, if you want to make sure your data room is investor ready, I put together a free resource called the Investor Magnet Checklist. It's the same 9-point framework we use with clients raising $10 million or more. It'll help you spot the red flags that kill raises before they even start. So link, as usual, is in the description underneath the video. Number 6, the best pitch deck is one you barely need. Here's a test. Can you pitch your company in the elevator, in the bathroom, over drinks without a single slide? If not, you're not ready. Your deck should support your story, not tell your story. I've seen founders give killer presentations with 0 slides. I've also seen founders absolutely bomb with 40-slide masterpieces. The difference? Clarity. Practice your pitch until you can deliver it in 60 seconds, in 10 minutes, in 30 minutes, without any visuals. Master the verbal pitch first. Then build the slides that make it stronger, because investors invest in founders, not PowerPoint presentations. And the best founders don't need crutches. Number 7, real investors say no fast. The fake investors say maybe forever. Now here's the truth that'll save you months of wasted time. If an investor says maybe and 3 weeks go by with no movement, that's a no. That's a hard no. They just don't have the guts to say it. Real investors with real conviction move like sharks. They ask tough questions immediately. They check your data room within 48 hours. They book follow-up meetings within a week. They want to place their capital. They give you a clear timeline for decisions. Fake investors say they're interested but never schedule calls, ask for just one more document every single week, tell you they're still reviewing for months, always have one more partner who needs to see it. Here's the Harvey Specter pro move. You send weekly momentum emails. Hey, we added 2 strategic investors this week, or we're 60% subscribed and closing fast, or final spots filling quickly. Create urgency, create scarcity, force decision, because time kills deals and maybes kill that momentum that you so desperately need. Number 8, valuation is a chess move, not a hill to die on. I once watched a founder argue for 3 months over a $5 million valuation difference. He lost the entire deal. Here's what I learned. Valuation is just framing. It's a number in a negotiation. It's not your self-worth. It's not your company's destiny. Use data to justify it. Show comparable companies. Reference previous rounds. Point to revenue multiples. Anchor with industry standards, but be flexible. Here's a question for you. Would you rather have 20% of a $50 million company or 25% of a $40 million company, their lowball offer? Do the math. 10 million versus, you guessed it, 10 million. Fight the battles that matter. Here they are. Board control, liquidation preferences, anti-dilution provisions, vesting schedules, valuation. Valuation makes headlines. Terms make millionaires. Moral of the story here is play chess, not checkers. Number 9, you're not begging for money. You're selling ownership of an empire. Now, this is the mindset shift that absolutely changes everything for you. You're not asking for money. You're not requesting funding. You're not seeking an investment. You're selling early ownership in a future empire that they want to participate in. Listen to that again. Listen to it out loud. Play it a couple times. You are selling ownership in a future empire that they want to be invested in. When you show up as a beggar, you get treated like one. However, when you show up as the CEO of the next unicorn, of the next empire, you get treated like one. Here's how this changes your approach. Instead of, would you be interested in investing in our company? Say, we're offering a limited number of strategic partners in the opportunity to join our cap table. Instead of, we really need this funding. Say, we're selectively choosing investors who can help us dominate this market. Instead of, please consider our proposal. Say, this opportunity won't be available much longer. You are the gatekeeper of something valuable. You are the architect of something transformative. You are the CEO of something that will change the world. I want you to walk into every room like you own it, because soon you will. Look, raising capital isn't about having the best idea or the prettiest pitch deck for that matter. It's about understanding the game better than everyone else playing it. It's about showing up with confidence, leverage, and proof. It's about treating investors like strategic partners, not saviors. And more importantly, it's about remembering that you're not just building a company, you're building an empire. Something they're going to be jealous and envious of if they don't participate in. And empires aren't built by people who beg. They're built by people who demand excellence and deliver results. Now go raise some serious capital. Now, my last piece of advice would be to check out this video here. Your pitch deck truly is an extremely important component of raising capital, let's be honest. And if you mess it up, you're at risk of missing out on funding and the right investors that would otherwise happily get behind your company's growth vision. You don't want to miss that. So in that video, I break down the common pitch deck mistakes I've seen year after year, and also how to avoid those mistakes. So if you're serious about raising capital, I'll see you over there.